Have you ever thought about how something really small could cause a massive, system-wide problem? Well, there's a fascinating theory making the rounds that suggests a tiny commodity market, silver of all things, might just be the tripwire for the entire global financial system. It sounds pretty dramatic, I know, but the logic behind it is, well, it's compelling. Let's get into it.
So that's the big question we're digging into today. Is it possible? According to this analysis, silver isn't just another precious metal. No, it's being looked at as a kind of early warning system, a signal flare that the very foundations of our complex financial world might be under some serious stress.
And look, this isn't just some abstract theory about a far-off future. The source we're examining today is blunt about it. They say the fuse might already be lit, that the sequence of events could already be underway. That quote right there really sets the tone for everything we're about to unpack.
Okay, so here's our roadmap for today. We're going to walk through this theory in 5 simple steps. We'll start with what's being called the silver spark. Then we'll look at why the system is like a financial house of cards. After that, we'll trace the contagion effect, see how it could spread. Then we'll tackle the big currency question. And finally, wrap up with what this all means for hard assets versus paper promises.
So, let's start at the beginning. Part 1, the silver spark. What exactly happened in the silver market that got everyone so concerned and kicked off this whole line of thinking?
Well, the story goes that it all started with reports that China was restricting its silver supply. Now that caused the physical market to get really tight and of course prices started to jump. But here's the crucial part. The most important thing wasn't the price. It was how the conversation changed. Suddenly, nobody was just asking, how high will the price go? Instead, they started asking a much more troubling question. Can you actually deliver the physical silver you promised me?
And this quote just nails the whole idea. Silver is a small market, which means it can get chaotic fast. It's not the whole building you see, it's just the alarm system. It's that thin wire. And if promises start to break there, it's a huge red flag that the trust holding the entire system together might be starting to fail everywhere else too.
Now that silver spark is only really dangerous because of the structure it's threatening to ignite. So that brings us to part 2, this financial house of cards. At the very heart of the system is a concept we've all heard of, but it can be a bit confusing. Derivatives.
So what are derivatives, really? Well, let's keep it simple. They aren't real things, like a bar of silver or a share of Apple stock. They're basically just promises. They're bets between two parties on the future price of something else. And the size of this market for promises, it's almost impossible to comprehend.
This right here gets to the absolute core of the risk. The entire derivative system is built on one thing: trust. It's all based on the belief that if your bet goes wrong, you'll be able to pay up. But what happens when that belief, that fundamental trust, starts to wobble?
The source we're looking at uses a great analogy. It describes this market as a kind of private poker room for the world's biggest banks. And in that room, it's all about confidence and reputation. Everything runs smoothly, just as long as everyone at the table believes everyone else has the money to cover their bets.
And this is what we've ended up with: an enormous, towering skyscraper of leverage, built by stacking promises on top of more promises. It might look impressive from the outside, but we've all played Jenga, right? You know, you just need to pull out one wrong block from the bottom, and the whole thing can come crashing down.
So that brings us to the most critical piece of this puzzle, the contagion effect. How does a problem with one tiny Jenga block, in this case silver, actually threaten to topple the entire tower?
The theory lays out a pretty clear chain reaction. First, the scramble for physical silver starts. That's step 1. Then, the doubt begins to spread. The big players start wondering, okay, if they can't deliver silver, what else can't they deliver? That crisis of confidence then jumps to gold, then to oil, and eventually right into the plumbing of the credit markets. All of a sudden, it's not a silver problem anymore. It's a system-wide trust problem. And what do banks do when they get scared? They stop lending. They hoard cash to protect themselves. And how do you raise cash in a hurry? You sell whatever you can, especially stocks. And in a panic like that, everything gets sold at once.
We're about to get into the really big picture implications of all this. So if you're finding these explainers helpful, please take a quick second to like, share, and subscribe. It honestly helps us keep breaking down these complicated topics for you.
Okay, so a market crisis is one thing, but how does this domino effect end up threatening the dollars in our own bank accounts? Well, this is where the policymakers step in, and they find themselves caught between a rock and a hard place.
According to this analysis, central banks are stuck in a debt trap. On one hand, they could tighten policy, raise interest rates to fight inflation. But if they do that, they risk blowing up the very credit markets that are already shaky. The system has too much debt. It just can't handle higher rates. On the other hand, they can ease policy, print more money to bail everyone out. But if they do that, they risk destroying the purchasing power of the currency itself. So they're forced to choose. And time and again, the path of least resistance is to save the system and sacrifice the currency. And when regular people eventually realize that their savings are shrinking, not because things are getting more expensive, but because their money is becoming worth less, well, their behavior changes. They stop trusting paper money, and you see a flight into real stuff, a scramble for anything tangible that can hold its value. Now, when you look at it through this lens, China's actions start to look less like random moves and more like a very deliberate long-term strategy. They're controlling key materials, they're stacking up gold, they're moving away from the dollar. It's as if they're setting up their board for a world where trust in paper money is fading, and as the source says, they're just letting the current system collapse under its own weight. And all of this leads us to our final and maybe the most important section. It forces all of us to ask a really fundamental question about what we even consider to be wealth.
The analysis draws a very sharp line in the sand between money and credit. Real money, like physical gold for instance, is final settlement. It's an asset that doesn't require someone else's promise to have value. But credit, and that includes almost everything from your bank deposits to bonds, is nothing more than a promise to pay. In the good times, credit feels just like money. But in a crisis, that promise gets tested, and as the source puts it, that's when it shows its teeth.
So the takeaway here is not about panic. It's actually about sensible risk management. The argument is simply that in a financial system that's so heavily built on trust and promises, it might be wise to think about converting some of that promise-based wealth into real, tangible assets, things that hold value on their own, no matter what. And that leaves us with this final, powerful question to think about. It really wraps up the entire theory. If policymakers are forced to choose between saving the system or saving the currency, and they almost always choose to save the system, then what do we want to be holding when everyone else finally realizes that it's not prices going up, it's the value of our money going down? That's a critical thought to end on.